Hello, everyone, and welcome. Today, we're cutting through the noise to discuss one of the most critical topics for your finances, the recent undeniable slide of the US dollar. Whether you're planning a vacation abroad, managing investments, or just tracking your everyday purchasing power, what's happening with the dollar impacts you directly. For American households and businesses, understanding these shifts isn't just about market speculation, it's about real world economic ripple effects. Let's explore why your dollar isn't as strong as it used to be and what lies ahead. The US dollar has been under significant pressure, recently hitting its weakest levels in 7 weeks, marking a notably poor price action in the currency market. This broad decline in the greenback is not a simple phenomenon, but a confluence of factors primarily stemming from shifting expectations around domestic interest rates and an escalating trade policy landscape. Analysts have even observed a breakdown in the traditional correlation between the dollar and U.S. Treasuries, indicating a broader sell America thesis taking hold among some investors, who might be reconsidering their global portfolio allocations. A major driver behind the dollar's recent underperformance is the softer than anticipated inflation data that emerged this week. Specifically, May's CPI, or Consumer Price Index, rose by 2.4% year on year, which was below the 2.5% that many analysts had predicted. Furthermore, the core CPI, which strips out volatile food and energy prices, eased to 2.8%, again falling short of the expected 2.9%. These figures are crucial because they directly influence the Federal Reserve's decisions on interest rates, providing the central bank with more flexibility to adjust monetary policy. With inflation showing signs of cooling, market participants are now more confidently betting on the Federal Reserve initiating interest rate cuts this year. Current projections strongly indicate an 80% chance of the first 25 basis point rate cut occurring as early as September. Looking further ahead, markets are even pricing in a total of 100 basis points of rate reductions by September of next year. These expectations for lower U.S. rates, driven by softer economic data, naturally put downward pressure on the dollar as it makes dollar-denominated assets comparatively less attractive to global investors seeking higher returns. Adding to this sentiment, recent political commentary has consistently called for the Federal Reserve to lower interest rates, further aligning with the market's dovish outlook. Investors will be closely watching the Producer Price Index, or PPI, due for release today, as it serves as a key input for the Core Personal Consumption Expenditures Price Index, or PCE, which the Federal Reserve closely monitors for inflation trends. A softer PPI could reinforce expectations for rate cuts. Adding another layer of complexity to the dollar's woes are the renewed tensions surrounding international trade, a factor that consistently weighs on risk sentiment and the U.S. dollar. Recent statements from the U.S. administration have particularly rattled markets. The president reiterated his intention to send out letters within the next week or two to various trading partners, outlining unilateral tariff rates. These take-it-or-leave-it proposals are designed to dictate the terms of trade deals, essentially adding pressure on countries that have not yet complied with U.S. demands. This escalation in trade tensions is widely perceived by investors as detrimental to the American economy, thereby weakening the dollar. Indeed, the underlying uncertainty over what comes next for global trade, particularly given the scant details of a framework agreement previously reached between the U.S. and China, has continued to dampen the overall mood in markets. Despite claims of progress in negotiations, the president also announced that the U.S. will maintain an effective 55% tariff on Chinese imports, contrasted with a 10% tariff on U.S. exports to China. This mix of vague progress and aggressive rhetoric keeps the risk of a cliff-edge jump in tariffs on the table, which continues to be a significant negative factor for the dollar. For American consumers and businesses, this implies potential volatility in import prices, uncertainty in supply chains, and a direct impact on profitability and purchasing power. The focus remains on whether these negotiations, including those with Japan, South Korea, and India, will allow for extensions beyond the July deadline, or if new trade restrictions will be imposed. As the dollar retreats from these pressures, other major currencies are seizing the opportunity to gain ground. The euro, for instance, has emerged as a significant beneficiary, recording notable gains against its main rivals and particularly surging against the US dollar. It recently climbed to a 7-week high against the dollar, trading at levels not seen in months. This strength in the euro is partly attributed to more hawkish rhetoric from the European Central Bank, which, unlike the Federal Reserve, recently cut cut interest rates but hinted at a potential pause in its year-long easing cycle after inflation returned to its 2% target. This divergence in central bank policies makes euro-denominated assets comparatively more attractive than those in dollars, driving capital flows away from the US and contributing to a narrative some are calling de-dollarization. While the euro gains strength, other currencies demonstrate varied performances that indirectly affect the dollar's standing. For example, the British pound has faced its own set of challenges, underperforming against the euro and remaining flat against the dollar. The UK economy has shown disappointing figures, including a surprise 0.3% month-on-month contraction in April's GDP and a significant drop in employment in May. Concerns about the UK government's fiscal sustainability, marked by a massive spending spree and rising tax burdens, have further weighed on sterling. For American investors, this highlights how global economic policies and trade dynamics are influencing various currency pairs, indirectly reflecting on the overall strength or weakness of the US dollar in a complex global market. Meanwhile, other currencies, like the Australian dollar, have seen a consolidation of recent gains, benefiting from a general abatement of US-China trade tensions, which has positively impacted currencies sensitive to global risk sentiment. While the specific dynamics of these currencies involve their own central bank policies, their ability to gain ground or hold steady reflects a broader environment where the US dollar is broadly losing its upward momentum due to domestic and trade-related uncertainties. This suggests a global reevaluation of where capital is best deployed, moving away from dollar strength. Despite the prevailing bearish sentiment around the dollar, there are a couple of factors that could potentially offer some near-term support. The first is that the dollar is currently very stretched versus interest rate differentials, suggesting it would require a substantial further decline in short-dated US rates to justify a much larger fall. The second factor is geopolitics. Rising tensions, particularly in the Middle East with speculation about potential military actions, typically lead investors to seek the safety and liquidity of the dollar. Historically, the dollar benefits as a safe haven during global instability, and higher oil prices, often a result of such geopolitical concerns, could also be a dollar positive due to America's comparative advantage in energy independence. Yet, despite these rising tensions, the dollar has not gained significant safe haven traction recently, as the overwhelming sentiment has been dominated by expectations of a more dovish Federal Reserve. For now, the influence of domestic monetary policy expectations appears to be stronger than traditional safe haven flows. In summary, the current environment for the US dollar is marked by significant headwinds. Softening inflation data, coupled with a Federal Reserve that is increasingly expected to cut interest rates, is diminishing the appeal of dollar assets. Simultaneously, the reemergence of aggressive tariff rhetoric from the US administration is adding further uncertainty and pressure on the currency. While geopolitical tensions historically offer a boost to the dollar as a safe haven, this effect is currently being overshadowed by the dovish monetary policy outlook. The dollar's trajectory in the coming weeks will likely hinge on incoming economic data, particularly the Producer Price Index, which is due for release today, and any further developments in the trade policy landscape. Understanding these dynamics is paramount for anyone living in the United States, as they directly influence everything from import costs and investment returns to the overall economic outlook. Keep a close eye on these developments, as they will undoubtedly shape the financial landscape for the foreseeable future. Thank you for joining us today. We hope this explanation provides you with clearer insights into the complex forces at play affecting your dollar. Stay informed, and we'll see you next time.